Right, let's jump straight into this explainer. Today, we're looking at the ultimate life cycle event of a business. It's dissolution. Now, whether you're an accounting student, a seasoned business owner, or honestly just curious about how companies actually wind down, the financial mechanics behind closing a partnership firm are incredibly detailed and, I've got to admit, surprisingly dramatic. We are going to unpack exactly how a business closes its books for good.
We've got a tight roadmap for this explainer today. 1. The end of the line. 2. Partnership versus firm dissolution. 3. 3 stages of accounting. 4. Unrecorded items and goodwill. And 5. The insolvency situation. Let's get right to it. Section 1. The end of the line. What it actually means to close shop. We'll start with the legal why and explore what triggers the absolute end of a venture under the Indian Partnership Act of 1932.
So, the absolutely crucial point here is that dissolution is not just a temporary pause, right? It is the definitive legal end of the business relationship among all the partners. The word dissolution literally means to wind up or close down. Every single commercial activity of the partnership firm ceases entirely, except of course for the activities strictly required to sell off the assets and pay the debts. And there are several specific legal avenues that lead to this closure, generally falling into 2 buckets, voluntary or compulsory. Partners can just voluntarily agree to close shop, or sometimes the partnership naturally expires if it was set for a specific time period or maybe formed for a specific venture that's now finished. But it can totally be forced too. If all partners or all but one become insolvent, the firm dissolves. If the business suddenly becomes illegal, it dissolves. Interestingly, for a partnership at will, meaning a partnership with no fixed end date, a partner literally only needs to give 14 days notice to dissolve the whole firm. And finally, an honorable court can step in and order a dissolution on legal grounds, like if a partner is of unsound mind or guilty of severe misconduct. Moving on to Section 2, partnership versus firm dissolution, reconstituting versus completely shutting down. Now, what's really fascinating about this concept is that dissolving a partnership is vastly different from dissolving the firm itself. The terms sound identical, but legally and financially, worlds apart. Think of it this way. Dissolution of partnership means a business actually continues. The relationship is just reconstituted. Maybe a partner retires or a new one comes on board. It's exactly like replacing a band member. The band still plays on, right? It requires revaluing assets, but there's no final closure of the books. And a court cannot order this. On the flip side, dissolution of the firm means the business discontinues completely. The band breaks up forever. Assets are sold off, liabilities are paid, the books are permanently closed, and as we just talked about, a court absolutely can't order this. Okay, Section 3, 3 stages of accounting, the financial cleanup. Let's transition to the how and see how this all builds into the 3 meticulous stages of a simple dissolution, where solvent partners settle the score and close the books forever. These 3 chronological steps are the absolute core of the financial cleanup. Step 1 is the transfer stage. You take all your sundry assets, which is just accountant speak for your miscellaneous assets, and your third-party liabilities, like bank loans, and you move them from the balance sheet to a special temporary account called the realization account. And crucially, you do this at their original book value. Step 2 is the realization, or disposal stage. This is where you actually sell the assets for cash, and then use that cash to pay off your outside liabilities and any dissolution expenses. Finally, Step 3 is the distribution stage. That realization account we made, it's a nominal account, meaning it's temporary, just used to track gains or losses. You close it out to find your total profit or loss on the whole process. That gain or loss is then simply transferred to the partner's capital accounts based on their agreed profit-sharing ratio. Now, when it actually comes time to pay out the cash you made from selling those assets, you can't just hand it out however you feel like it. According to Section 48 of the Indian Partnership Act, there is a very strict hierarchy for paying out money. Number 1, you must pay the realization expenses, literally the cost of closing down. Number 2, you have to pay outside liabilities, your third-party debts. This guarantees external creditors get their money before the partners see a single dime. Only if there's surplus cash after all that do you move to Step 3, repaying any loans the partners personally gave to the firm. And finally, if there is still cash left over, it goes toward paying back the partner's capital balances. Section 4, unrecorded items and goodwill, handling the financial surprises. Because let's be real, what happens when things pop up that weren't on the official balance sheet? This is a massive reality check for any business owner. You're in the middle of closing down, and suddenly a creditor appears out of nowhere. Or maybe you find a piece of equipment that was fully depreciated and written off, but hey, it still has market value. Surprises happen all the time, and the accounting process has a very specific plan for them. The rule here is incredibly simple but strict. Even if you forgot to write it down, if it has value, you sell it. If you owe it, you pay it. When an unrecorded asset is sold, it bypasses that whole transfer stage and goes straight to the realization stage. Your cash or bank account is debited. Similarly, if you pay an unrecorded liability, your cash or bank account is credited. It all just runs through the realization account based on its actual or agreed upon value at the time of closure. And sometimes this works heavily in your favor. Intangible assets like goodwill can be an incredible hidden surprise. In one case study from our source material, a firm run by partners Asha, Usha, and Nisha, the firm's goodwill was realized for 48,000 rupees. So even if goodwill isn't explicitly sitting on your balance sheet as a massive number, your firm's reputation might still hold serious value, bringing a very welcome injection of unexpected cash right at the end during the disposal stage. Finally, Section 5, the insolvency situation, when the money runs out. We've arrived at the climax of our chronological journey, the worst-case scenario. We've been talking about a simple dissolution where everyone is solvent, but what if they aren't? This is where the comfortable protection of a simple dissolution completely vanishes. In practice, insolvency means an individual or a firm simply cannot raise enough cash to meet its obligations as they become due. When this happens at the end of a partnership, well, partners have to dig into their own personal pockets. Which brings us to capital deficiency. After all the assets are sold and all the liabilities are addressed, a partner's capital account might actually show a debit balance. This means they literally owe the firm money to make the accounts balance out. If that partner is insolvent, meaning their personal, private liabilities exceed their personal assets, they physically cannot bring in the cash required to settle their negative balance with the firm. And this triggers one of the most sobering rules of the Indian Partnership Act of 1932. Joint and several liability. The liability of partners is unlimited. If a partner is insolvent, their private property can be acquired and sold to pay their debts. But if there still isn't enough to cover their capital deficiency to the firm, that unrecoverable portion doesn't just magically disappear. Because liability is joint and several, the remaining solvent partners are legally forced to absorb the insolvent partner's deficiency, and they absorb it in their agreed profit-sharing ratio. It's kind of wild when you think about it. Quite literally, your partner's financial failure legally becomes your personal burden. But let's take it one step further. What if all the partners are insolvent? If everyone goes completely broke, then third-party liabilities cannot possibly be paid in full. The accounting procedure has to change slightly here. Third-party liabilities are not transferred to the realization account at all. Instead, the firm simply pays what little available cash it has to the third-party creditors in proportion to what is owed to them. After that, the remaining unpaid debts and the final balances of the partner's capital accounts are permanently parked in a special deficiency account. It's basically the firm's way of officially recognizing losses that physically can never be paid, finally allowing them to close the books once and for all. Knowing how to legally and fairly close a business protects your livelihood, your personal assets, and your external creditors. It is a meticulous process of tracking every single rupee, from the transfer stage all the way down to covering a partner's capital deficiency. It leaves us with this final thought. Starting a business is exciting for sure, but closing it down properly, ensuring every debt is managed and every asset accounted for, truly showcases the heavy shared responsibilities of partnership. Thanks for joining me on this explainer, and I really hope you walk away with a much clearer picture of how a firm takes its final bow.